Hey folks, welcome to Quantsapp and welcome back to yet another video. So you might have heard about a lot about straddles and strangles these days, because these are the strategies, non-directional strategies, which a lot of traders are trading these days in current market conditions. So now talking about straddles and strangles, so you might be wondering as well, what are the key differences between straddles and strangles, except just selling different strike prices. What are the differences? So we will cover that in this video. And the reason there exist two strategies is because both these strategies should be deployed or should be tried in various market conditions and different market conditions. So that is something what we will cover in this video. So to start off with, let's understand what is a straddle. So for those who don't know what is a straddle, so straddle is nothing but you go ahead and buy or sell the same strike price, call and put option. If you buy call and put option both of the same strike, it will be called as a straddle, okay, a long straddle. If you sell call and put option of the same strike, it will be called as a short straddle. So let's say we create a short straddle, 18650 call option, we are going ahead and selling it. 18650 put option, we are going ahead and selling it. So now the architect will show us on what various levels how much profit or loss we are making. This is an you know undefined loss or unknown loss strategy. So your loss is non-known, you can face a big loss in this strategy. So typically these type of strategies, they have unlimited loss, but the benefit is that the theta is positive over here, so you will get the theta benefit from this strategy. So the more you hold this option strategy, the more premium is going to get decayed and the more profit you are going to earn in this type of strategy. So this is a short straddle. So the thing with this strategy is that at whichever strike price you sell the straddle, okay, so wherever you create a short straddle, that is the level where you will make maximum profit. If market expires, let's say we sold 18650, if market expires exactly over here, that is where you will make the maximum profit. Now the thing with this strategy, see, it is getting a mountain peak is getting formed, and immediately after that, on both the sides, see, on both the sides, if the market does not end up exactly over here, your loss starts immediately. So to tackle that, we have another strategy in the market which is named as strangle. Again, if you buy calls and puts of different strike price, it would be a long strangle. If you go ahead and buy or sell call and put of different strike price, it would be called as short strangle. So short strangle is nothing. In short straddle, you went ahead and sold the same strike. In short strangle, you go ahead and sell the different strike price. So let's say you go ahead and sell 18,800 strike price call option. So a short call is getting created. You add a leg. Let's say you go ahead and sell a put option of 18,500. Okay. So see, now you are getting a much more flatter curve. So market even spending some time on either of the levels, you will still make some profit, right? So whenever you feel that market will remain in a broader range, okay, as long as you expect that okay, market will exactly end up at 18,650, at that time I would say the straddle makes a lot of sense. But if you feel that okay, market might go roam in a wider range, then strangle is the strategy for you. Now coming to the right time to select these strategies, one of the key factors is expiry. How close are you to the expiry? Now as the time passes by, the premium, it keeps on decay, right? Now if you are very close to the expiry, what you will do is you will create a strategy. The reason being, you are getting enough premium from the ATM call and put to give you a better cover. Okay, थोड़ा ज़्यादा cover दे पाएगा आपको, right? But if you are away from the expiry, if the expiry is far away, and if you know that okay, there is some time left for the expiry, so you will get better premiums, right? You will get bigger premiums. So let me just show you what I mean is, let's say on 18,000 29th of December expiry, see, on 18,900 call as well, you are getting 92 rupees premium, which is lucrative, right? Even on 19,000 you are getting 60 rupees premium. So if the expiry is far away, strangled would be much more of a better strategy to go ahead with. The reason being that you are getting lucrative premiums from both call and put options, and which will give you a better cover in the market. Okay, so that is the first thing. So if you are closer to expiry, you need more premiums for better profits, obviously. Second thing, to get a better cover. So be it expiry day or be it, 1 or 2 days before the expiry, typically straddle is the strategy what you will try, because the thing is you want some profit, right, from the market, because you are taking unexposed, you are taking an unknown loss in both the strategies. So why not take a better reward to risk and go ahead with a straddle? But whenever expiry is far away, you know that you will get some benefit from the premium. The premium would be bigger and you will get more cover on the calls and puts. So you can still try it out with the strangle. Another thing is, now with the straddle, the thing was, see that there is a mountain peak getting formed. So if there is nothing happening, okay, if there is if there is a big move which comes in, okay, in the market in 1 or 2 days, okay, let's say if in 1 or 2 days big move comes in the market and you have deployed a straddle, so what would happen is it is not giving you enough width, right? It is not giving you enough width. So whenever you feel that you want to write options for a longer duration, okay, you are writing options for a longer duration, then you don't know, right, what the market, what where the market might go. So for that reason we will deploy such type of strategies, which is triangle, which will give you a better width. Okay, so this is how you will play around with it. First thing, if you are closer to expiry, straddle is a to go strategy, the reason being the premiums you get from the selling the ATMs. Second thing, if you are far away from the expiry, you can consider a triangle. And specifically when you have more days, if your forecast says that market will consolidate for a lot of time, strangle is the strategy to go ahead with, because the more you hold that strategy, those OTMs which you have sold, those will go towards zero and it will keep on giving you inflow. Now in that type of conditions, when a lot of time you need to be in the strategy for a lot of time, at that time the straddle may not be very lucrative, the reason being the peak is getting formed, right? You're not getting the width in the market. So that is the reason. Apart from that, before any value trade events such as results, be the budget days, typically strangles are the strategies which would be to go strategies for you. So yes folks, that was it from my side for this video. If you have liked this video, do hit the like button, do hit the subscribe button, so the next time we post any video, you will be the first one to receive it. Bye bye, take care, and be a data driven trader.